So where's the stock market headed? We know that in the first 8 full months, tech stocks have been doing great, but what's going to be a good buy now that is going to be a company stock that's going to be worth a lot more in 12 months? And I did that type of thinking, looked through all my watch lists and came up with two stocks that I think are going to be worth a lot more in 12 months. I'm going to share those two stocks with you, along with some analysis that I completed on those two stocks. My name is Victor. I have an MBA and I do analysis on companies that I'm looking to invest in. This video is going to cover two stocks, but I have a lot of other videos on my channel that you can take a look at where I look in depth on companies that I've looked to invest in. In some cases, I own those stocks. In some cases, I just look at them and I'm not willing to buy. In this video, I'm going to go over two stocks. I'm going to go over the reasons why I'm going into those two stocks and already put the buy orders on those two stocks. Now, let me go through and set up the stage to reveal these two stocks in the next couple slides. The first question I have to answer is where's the economy going and which sectors are going to be doing well in 6 to 18 months and which sectors are not going to be doing well. And really, as I look at the economy, unemployment has been manageable. We haven't gotten really high unemployment, I think, because there's scarcity of workers. So this recession that we have been expecting for 2 years hasn't really come, and unemployment's been really manageable. Inflation has been a real stubborn problem, and we're getting it closer to 2%, which is really good. The other factor that I'm seeing in the overall economy is China's recovering. China was really affected by COVID because they shut down their whole economy until COVID was under control, which had a big effect on their consumption as well as their production of goods. So that's really recovering, and that's going to help the economy as well. And in essence, I think the recession is going to be mild. Whatever recession we have over the next 12 to 18 months, I think it's going to be mild. So I think that sets up, certain sectors are going to win from a mild recession, and some sectors are going to be losers in that mild recession. Now, the headlines in the economy that we were heading toward a recession, I think discounted certain stocks, and I think it had a really big effect on certain sectors. And that's what I'm trying to capitalize. I'm trying to get to some stocks that are really discounted and really good buys at the current moment and are going to reward me with a really high return. And here's a couple of things to go over. First, I'm trying to estimate which economies and sector economies, meaning is manufacturing going to do well? Are professional services going to do well? As an example, financials, are banks going to do well? And estimate which sector economies are going to do well in 2024 and 2025. Take that into account, along with buying into companies that only have quality balance sheets. So if we have a company that is discounted, typically means that it's a turnaround story, that maybe their revenue is down, maybe their profitability is down. Well, if they have a really quality balance sheet, they're going to have the wherewithal, they're going to have the resources, the cash to really make it through to the other side of that downturn. So they have to have a quality balance sheet. And I want big returns. So these two ideas, I'm expecting an above S&P index return. So the two companies that I'm going to buy in September, first one is Dow. It's a material company. You may know them as Dow Chemical. And Dow Chemical, they provide materials to companies that make products. They make packaging. They paint things. They basically take the Dow materials and input into their manufacturing. With manufacturing being down, as I mentioned, China had been on lockdowns as an example. That's a big manufacturer. Dow, their revenues have been slipping. They've been going down from year to year. But I think as China comes back online and as the economy really begins to expand, Dow products are going to be in demand. So I believe that Dow is a good place to take a look at. And the second is Zim. Zim does ocean freight. So if you want to move a container from Europe to the US or from Asia to the US or from Asia to Europe, Zim is a company that will move that freight for you. And when we had the big supply chain issues, Zim was making lots of money because the ocean rates were really high. They were making incredible amounts of money and paying huge dividends. Well, now rates are really collapsed and they're really low. And the value of this stock is really low. So what I'm expecting is as the world economy begins to kind of get back on its feet and really begin to get closer to 100% capacity, the ocean freights are going to rise. And I'd like to buy Zim stock ahead of that. So let me go into a closer look of each company and share with you how discounted I believe both companies are. Starting with Dow, I believe Dow is discounted by 40%, meaning that I believe their shares are worth $77.47, but the market will sell you shares right now at $55 per share, leaving you a good discount of 40%. On top of that, they pay a 5% dividend. So they pay a nice dividend and they're discounted. How do I get to that type of discounted calculation? I look at two things, free cash flow and earnings per share. First, with free cash flow, I estimate what they're going to make in free cash flow in the current year, meaning 2023. And to get there, I took 2022 figures, and I'm going to take 70% of that. Revenue is down, and free cash flows are down as well. Now, 70% is a conservative number. I think they're probably going to do a little better than that, but I want to start conservative. They are going to generate, on my estimation, almost $4 billion in free cash flow for the current period. And they're going to grow those free cash flows because I think the world economy is going to improve by 10%. So I start with a conservative number, but they're going to grow at 10% over the next 4 years. After that, they're going to grow at 3%, which is a good factor to establish the terminal value, which is all cash flows beyond year 4. Based all these cash flows, I'm going to discount to today's net present value by 9% as a weighted average cost of capital. That calculation gets us to $73.4 billion of value for those free cash flows. I'm going to add almost $3 billion of cash that this company has on their balance sheet. And they have debt of $15 billion. So I'm going to take that out. So I'm going to add the cash and take out the debt. To get to an equity value of Dow, the whole company, I believe is worth $61 billion based on their free cash flows. But based on their market cap right now, they're just shy of $39 billion. So it offers up a 58% discount if you value the company based on free cash flows. That's a really nice discount. In other words, each share is worth $87 per share, but you can buy shares all day long for $55. Now let's take a look at earnings per share. Earnings per share is down compared to last year and the year before, but it's still a respectable number, and it's a good company. I'm going to use a PE of 18. They've traded in PEs higher than that, but I think it's a good number to go on. And again, I'm taking numbers that I expect in 2024. So this is going to be kind of like the future PE and the future earnings per share that I'm expecting out of Dow. Based on those rates and a 3% growth rate, I get to a stock price of Dow $58.04. It's close to fair value, which is $55.29. And you get about a 5% discount on Dow. I combine the two and I put more weight in the free cash flow method, and it revealed a 58% discount, and then less weight, 1/3 of the factor in the earnings per share value. And I get to a 40% blended discount on Dow stock. A couple other things to just go over. The balance sheet has to be in good shape, and Dow has a solid balance sheet. They have debt of $14.9 billion, but their EBITDA is $6.7 billion. So their debt to EBITDA is 2.2. And what I want is less than 3 as a ratio. So it's a solid balance sheet, very solid company, making money, profitable, paying a 5% dividend as well. So if it takes a little while for them to get to this type of valuation, that's okay. I'm getting paid 5% with a very good company. The next stock I'm going to buy is much greater risk, but I think a higher reward. And the company is Zim. Zim provides ocean freight services. They'll carry your containers from Asia to the Americas, Asia to Europe. And over the last couple of years, they had historic, great years. And now shipping rates have really dropped, which is causing Zim to be unprofitable. But when shipping rates rise, I think Zim's going to be in a position to be really profitable again. Now, this is a high-risk idea. I'm going into it early, expecting that shipping rates will change over the next 6 to 12 months. And when they do so, then I could see my stock price go up. At this point, just based on the information that I have, they are discounted heavily. Let me take you through that. I'm really valuing Zim based on free cash flows. They don't have a profit currently because shipping rates have dropped, so I'm not going to use earnings per share value. Instead, I'm going to take what they currently have produced for the first half of 2023 in free cash flow. And to be conservative, I'm going to pretend that they're not going to generate any more free cash flow for the remainder of this year. In addition to that, I'm going to take down free cash flow in years 2, 3, 4 by 10%. So as you can see, this is a declining amount of free cash flow that Zim is going to produce, giving them roughly a 4 to 5 year, range for them to really just keep operating, manage cost, and be a good, effective operator. One thing that is going on is the amount of volume that Zim is transporting has actually gone up a little bit. It's just the rates have gone down significantly. If we look at past year 4, I'm going to grow everything in the terminal value by 2%. Nice conservative rate. And we're going to keep shipping stuff around the world as, products get made in different parts of the world, and they need to be shipped efficiently to other parts of the planet. So at that rate, it's going to produce everything in the terminal bucket will be $3.2 billion. And all these cash flows, I'm going to discount at a very high weighted average cost capital of 14%. Even though Zim has a very strong balance sheet, this is a very volatile industry, so I want to be conservative. Based on a 14% discount rate, the value of those free cash flows is worth about $2.9 billion. They have $1 billion of cash on the balance sheet and $131 million of debt. So the equity value of Zim is $3.8 billion, but their current value based on the market cap is $1.47 billion. So it really provides about 159% discount if you really look at those free cash flows. And so there's just a big delta between cash flow value and where the stock's trading. The balance sheet is in good shape. They have very little debt, very good to see. They produce free cash flow, very good to see. So I think they can weather, a 12-month period of bad, shipping rates and wait for those shipping rates to recover. China's coming back online. China's beginning to produce, getting closer to 100% capacity. And I think that's going to put a strain on shipping, capacity. I think India is really developing their economy. That's going to put stress on the shipping capacity. So somewhere down the road, we're going to see these shipping rates rise. I don't know when, but I'm willing to put some money into Zim, expecting that when those shipping rates rise, I will be a beneficiary of that. Year to date, the company is down 28%, and it was already down significantly in 2022. They pay a high dividend. I'm not putting an amount because they just pay out 30 to 50% of their profits, and they're not profitable currently, so there's no dividend. But if and when they get profitable again, they'll pay out 30 to 50% of those profits. And that's Zim, a very high risk idea, not for everybody. I'm willing to put a little bit of capital into Zim because I did make money on one of not their competitors, but another ocean freight company. I did really well with Panel, and you can see that video on my channel. I made great money on Panel, so I'm trying to repeat what I did before with Zim and Panel. So those are the two stocks that I'm going to buy here in September. One of them I think is fairly straightforward, Dow. I think it's a solid company. I've owned Dow over the last 5 years. I've owned Dow and sold, successfully making money and collecting that nice dividend. Zim is a big bet, and it's a high risk, proposition. But boy, if that works out, that could really double my money quickly, maybe even triple it. And then the key will be once you're in, once rates go up, is having a good exit strategy, knowing when to sell your Zim stock. So those are my two ideas for September. I hope you found it interesting. Love to get your thoughts on it. Please comment on both companies, what you think of the two companies, and let me know which stocks you're buying here in September. I would love to hear some ideas and maybe pick up a third that I'd want to buy here in September. Do me a big favor and like my video, and also subscribe to my channel. I'd really appreciate that. And just last comment, I'm an individual investor. I'm not a stock advisor or an investment advisor. I'm not recommending you buy Dow stock or Zim stock. I'm just sharing my experience as an individual investor. Good luck investing in 2023.